Hi guys, Sarah Perkins here, your credit education specialist as well as debt resolution advocate. And I'm here today to share some information that will make helping you understand credit a little bit better and how to make it work in your favor. So some of the key topics I'm going to go over is what exactly is a FICO score and how does it compare to Credit Karma? Some 2023 credit updates, credit tips to increase your score on your own, as well as the biggest credit mistakes not to make. So a little bit about me before I get into everything, so you can kind of know my background and why I speak as a specialist on this topic. Like I said, I'm a credit education specialist and a debt resolution advocate. I'm currently partnered up with Blue Water Credit out of Roseville, California. I have over 20 years in the credit and debt industry. I started back in about 2001. I was an investigations department manager for a national debt buying agency. It helped me learn the ins and outs of credit card debt and how credit actually works and the legal process. During my time there, I got to serve as an expert witness for credit card fraud civil cases. I then transitioned over into debt management and debt settlement. I was certified with the IAPDA as a certified debt specialist and negotiation certified debt specialist. During my time as a debt negotiator, I've settled well over $10 million in credit card debt. And now currently I conduct credit workshops for mortgage and real estate experts. I collaborate with nonprofit organizations to provide consumer education on credit and debt. And you can always find me across all the social media platforms. I go by the Credit Boss Lady, whether it's on YouTube, TikTok, Instagram, and I'm really all about spreading credit and debt awareness because unfortunately there is a lot of bad information out there. So please look me up and follow me for more credit and debt tips. So now getting into the main content today is a little credit education. And what I hope you get out of this video is how to achieve and maintain a healthy credit profile. We all know that, credit is king. It doesn't matter sometimes how much cash you have. If you don't have the credit, the banks aren't going to lend you money, and it could hold you back from getting a job, renting an apartment, obtaining a vehicle. Credit is so important in our society, and it is so easy to damage your credit profile, and it can take a while to recover. So I want to make sure I equip you guys with the most knowledge, so you guys make sure that you make good decisions when it comes to your credit. So probably the number one topic that I get asked about all the time has to do with Credit Karma. Most of us are aware of Credit Karma, have the app on the phone. I even have the app on the phone. It does serve a purpose, but what is the big difference between Credit Karma and some of the credit scores you get online compared to like when a lender actually pulls it? It can be off sometimes as much as 100 points, and people really don't understand as to why that happens. And I like to break it down in simple terms and basically explain with credit scores. There are several brands out there, and I'm going to talk about the two major brands of credit scores. And then within each brand of credit score, there's always different versions. So the two main brands of credit score out there are FICO and Vantage. So Credit Karma is a Vantage score, and most lenders still go by a FICO score. Both are trying to do the same thing. They're trying to determine when they lend money out, what is the likelihood that that consumer will go 90 days late or worse within the first 2 years of having that credit extended to them. Vantage was developed by the three bureaus, Experian, Equifax, and TransUnion, essentially to compete with FICO, which has been around a lot longer. And FICO then determines the scores that go out to Experian, Equifax, and TransUnion. Still today, FICO is probably used in 90% or more of lending decisions. And the main differences between FICO and Vantage, I'm going to go over. So FICO mainly looks at 5 different categories that make up your credit score, where Vantage looks at 6. And so I have this visual up here that kind of breaks it down. And they do pretty much look at the same kind of information. both number one predictor of the score is going to be your payment history. So this is paying your bills on time. And this is also why when you pay something late, have a collections or a charge-offs, why it damages your score so much. You can see here with a FICO score, it makes up 35% of your credit score, but with Vantage, it's a little bit more, 40%. Other items they look at are the amounts that you owe, your utilization, how long you've had your credit accounts, your mix of credit, inquiries, but you can see they kind of put different weight on the different categories. And plus, like I said, Vantage has one extra category that they look at, and that can cause a variation between the two scoring models. One thing I like to point out as another main difference is in the FICO model, all lates are pretty much treated the same, whether you pay late on your car, late on your credit card, late on your mortgage, whereas Vantage treats mortgage lates as a lot worse than any other kind of lates. Also, another big difference is FICO, you need 6 months of credit history to even develop a FICO score, where Vantage, you only need 1 month of credit history, and it can even be a collection account. So I'm going to touch on why someone might have a 0 score a little bit later on this video. So also I mentioned there's various versions. So I'm going to mainly talk about FICO today because that is the one that lenders use. And you can see right here, there are many different versions of the FICO score. I think there's probably over 20 in all. There's ones for home loans, there's one for autos, there's one for credit card, personal finance, and just general use FICO scores. They vary in how they treat collection accounts, medical debt, and so those can cause some little variations by looking at what version is being used. So you can go and get a car and think your credit score is in the 700s, but then have a lender pull it for a mortgage and it be in the 600s. And that's, again, just little variations on things that are counted or not counted within the various versions here of the FICO model. And as you can see here with this visual, this happens to be a client where we pulled their credit score through Equifax, TransUnion, Experian, their FICO scores, as well as their Vantage score. And you can see all the variations of the score that can range, from the mid 600s all the way up into the 700s. So across even just Equifax, when you look at the different brands and versions there, there's a low to high difference of 58 points, TransUnion 72 points, or even just within looking at auto scores between Equifax, TransUnion, and Experian, those can differ as well too. And a lot of people are like, well, why would those differ? It's the same type of model or version. Why should it differ? And the main variances can be, the reporting date, they could have different reporting dates that don't include certain updates, the version that's being used. Some creditors don't actually report to all 3 bureaus. They could just report strictly to TransUnion, or maybe they do just Experian and Equifax. So if it's not reporting on one, but reporting on another, that can cause a variation in the score. Also, they can interpret the information differently that is provided to them. And there's always can be errors in the info that is reported. So the error can just happen solely with one of the credit reporting agencies, or it can happen across the board. And again, those can cause a variation in the scores as well. So how exactly is your credit score calculated? And this is, again, I'm talking about the FICO score because that's the one that's mainly used. So I'm going to break down the 5 main categories that FICO looks at and what exactly it means. So I touched on earlier that 35% of a score is your payment history. So this is why late payments, collections, charge-offs, bankruptcies are all items that can just have your score drop 100 points overnight. And why it does that is because it's the biggest determining factor of your credit score. So this is why it's so important that you guys are making sure that you pay your bills on time and really limiting late payments or collection type of accounts. The second largest category is 30%, and that is credit card balances or utilization. And when I mention utilization, basically you are comparing what the balance is on the credit card to the limit that you're given. So for example, with a card that has $1,000 limit, if you have a balance of $500, then you are at a 50% utilization. Ideally, to get the maximum amount of points in this category, you want to keep it under 10%. I know a lot of people will say good rule of thumb is 30%. And it is true to some extent. When you go over 30%, then you are actually deducted points from your credit score, but you can also earn points if you can get it under the 30%. And again, ideally under 10%. The next largest category at 15% is your average age of credit account. So older accounts are going to help your score. FICO likes to see the average length of time you've had your credit cards open be over 5 years. So it's going to take all your credit card accounts, look at how long they've been open, and average it out. This is why newer accounts, when you open them, can cause your score to go down because the average length of your accounts have been open will now decrease. This is also why closing old accounts can hurt your score, because if you've had an account that's open for 20 years and all of a sudden you close it, and then now you mainly have accounts that are within the last few years, now your average length of your credit accounts has dropped significantly and can cause a dip in your score. The next category is mix of credit. So they like to see a mix of open accounts, and ideally, again, 1 to 5 revolving credit card accounts, 1 installment loan, which is typically like an auto loan or a student loan, and then 1 mortgage would be, the recipe that they're looking for. So this is why if you have too many accounts opened in a certain category, or maybe you are lacking a mortgage or installment loan, why you're not getting maximum number of points in this category. And then last but not least is credit inquiries or new credit. So anytime you apply for new credit and a hard inquiry is pulled, and I'm going to go over the differences between hard and soft inquiries, but that can affect your score anywhere from 1 to 5 points. And again, anytime you then open new credit based off that inquiries, you're affecting the average age of your credit accounts. So now exactly where can you go to actually determine what your FICO score is? And so I am a big fan of a site called myfico.com. It's a website, and as far as I know, the only website where you can get all 3 mortgage FICO scores, which are usually the biggest concern for my clients when dealing with credit. They want to know if they can qualify for a home loan, but you do get an extensive report that includes all the different versions of FICO, whether it be their general or widely used version 8 and 9, your mortgage FICO, which is 5, 4, and 2, or your auto score, credit card score. You see it all there. They do typically have an offer of $29.95 a month where you can get a new score every 30 days, or you can do a one-time soft pull for $59.95. And so if you aren't working with a lender and you don't know your FICO score, I would definitely encourage you to pull a report here. Well, what if you pull the report and you have 0 credit score? It does happen, and people are always baffled as to why they wouldn't have a credit score. So with FICO, there's 3 minimum requirements to generate a score. I touched on one of them earlier on this video, but number 1 is you have to have at least 1 account open that's been open for the 6 months or more. So if you're brand new to the credit world and just opened a secured card, you're not going to have a score probably for 6 months. They need to see some credit history, payment history with that 1 account. And I'll give you a workaround on that if you need to get a score a little bit faster. The second requirement is there has to be at least 1 account that has been updated on the credit report within the last 6 months. So if you have credit, but then you stop using it, maybe you think you're being responsible by going to cash or using a debit card, and you just do away with using your credit cards. Well, if they sit stagnant for too long, then your credit score can actually disappear. This is why we recommend making sure that you are using your credit cards at least every 3 to 6 months. This will also help prevent your creditor from closing the account without you knowing. And last, it's not that common, but there can't be any indication that you are deceased on the credit report. So if you share an account with someone who passes away, this is where we typically run into this. Or if you're like a senior situation and senior passes away, sometimes those things can get mixed up, and then they can mistake you for being deceased, and thus your credit score can disappear. If you're curious as to what your credit just looks like and you're not too worried about your score, but you want to stay on top of what it actually is showing on your credit report, it used to be through annualcreditreport.com. You got one free credit report a year from each of the credit reporting agencies of Experian, TransUnion, and Equifax. During COVID, they changed that. They allowed you to pull one free credit report each week. And this was an attempt to have people have more access to their credit and what's going on, to stay on top of errors in reporting or identity theft. And they just announced in the last month or so that they are going to continue that indefinitely. So you can go to annualcreditreport.com, pull a new credit report each week, and it will give you all of your accounts to look at for each of the three bureaus. The one nice thing about this report, it shows the date a delinquency is scheduled to fall off. So if you do have any late payments, or collection accounts, and you're wondering how long it's scheduled to stay on your credit report, because most items, with the exception of some bankruptcies, can stay on for a max of 7 years, it will show you the month and year that it is actually scheduled to come off your credit report. The only downside with this credit report is that there are no scores given. It is a free report. It doesn't give any scoring models. It just strictly gives the content of what is showing on your credit profile. Now I'd like to go into a couple more updates. So I talked about the update with the free credit report weekly. During 2023, there were some major changes to medical debt in the credit world. So it started with paid medical collections being automatically removed once they are reported as paid within a 30 to 45-day window. So this is really big for people because just because you pay a collection doesn't mean that it actually comes off your credit report. In most cases, it will just show as paid and a zero balance. They thought that this was unfairly targeting certain demographics. And so a change was made that once a medical debt was paid, that the credit or the consumer reporting agencies would actually remove it on their own. The next change that happened with medical debt, which was just June of this year, was medical collections with a balance of $500 or less were automatically being removed from the credit report, so that people weren't being unfairly targeted for small medical debt. I've seen people before this policy went into effect that a $25 copay that was missed that went into collections, and it drove somebody's score down 100 points overnight. So they did away with that. So balances under $500 should not be reporting on the credit bureaus anymore. If it is over 500, they do have the right to still report it. But the other last change that was made is it used to be only a waiting period of 6 months, and then they can report you to the credit reporting agencies. Now they have to get the consumer 12 months before a medical collection can report on your credit, just giving the consumer more time to be aware of the medical debt, work with their insurance company or work with the agency that's handling it. So if you do have medical debt out there that's less than 12 months, I highly encourage you to work out some type of repayment plan before it hits your credit report, because medical debt does still have a big impact on your mortgage FICO. There are certain scoring models that don't recognize medical debt as being an effect on your credit score, but with the mortgage FICO score, it still does affect your score. So now let's talk a little bit about credit inquiries. I've mentioned the word hard inquiry or soft pull. And so what exactly is the difference between the different inquiries and how do they impact your score? So first and foremost, a soft inquiry. This has no effect on your score. And a soft inquiry is anytime you pull your credit on your own. It's like when you go to that myfico.com and look at your own credit, this will have no effect on your score because you are pulling it yourself. Background checks. So a lot of employers will do a credit check as part of their employment screening process. And that will have no effect on your credit score. Or if it's pulled by a business that you already have a credit account with, like if you are already have a credit card with Bank of America, they periodically may do a soft inquiry to just look at how your credit is doing, maybe make an offer for a credit line increase, or possibly if they see that you're defaulting on your other credit with your other creditors, they may drop your limit or even close your account altogether, but those inquiries will not have an effect on your score. The other one that has no effect on your score is the promotional inquiry. These are offers made by credit card companies that you don't currently bank with, but have received your information through kind of like a little bit of a loophole with the Fair Credit Reporting Act. So anytime you apply for credit, your information is sold to other companies that can mail you out or email you information based off this purchase credit data to offer you lines of credit or loans. So right now, if you do not want to receive those offers and you do not want your information sold, which I don't think many of you probably do out there, I highly recommend going to optoutprescreen.com. You go onto that website, you enter a couple bits of information like your name, address, social security number, date of birth, takes, just a couple minutes. And then after that, within 5 days, you are put on a list and your information can no longer be sold for promotional credit offers. And so it will hopefully cease all those junk mail offers that you get and not being bombarded by phone calls anytime that somebody does run your credit. The last type of inquiry is a hard inquiry, and that's what we're most concerned with a credit score, because it can affect your score up to 1 to 5 points. And basically this happens anytime you apply for credit, whether it be for a home loan, a car loan, a credit card, or any type of loan. In the mortgage FICO version, and this varies version to version with FICO, but in most cases, you typically have what's called a 30-day window to shop. And this allows you to have your credit pulled by different lenders for the same purpose, whether it be for shopping for a home loan or for a car loan, where that inquiry is only counted as one inquiry. Even though you may have it pulled by 5 different lenders for a car loan, it only hurts you that one time. Those inquiries will show up on your credit report, but you are only counted as one single inquiry within that 30-day window, starting from the first inquiry that you have. You can't mix and match for a home and a car, so it has to definitely be within one category, like a home, car, or searching for like an apartment. Hard inquiries can also come from credit line increase or balance transfer requests. So I always suggest, if you are asking for a credit line increase with somebody that you already have a credit line with, if it's going to be a hard inquiry or soft inquiry, because it can drop your score a couple points. And why is this important? Well, through some studies, they show people with 6 or more inquiries are 8 times more likely to file bankruptcy than somebody with 0 inquiries. So it's just an indication of risk in lending. They see people that are constantly shopping for credit cards or loans as having a little bit more riskier behavior. And so that's why inquiries can impact your score. You will see up to 24 months of inquiries on your credit report, but no, only the ones from the last 12 months actually have an impact on your score. Another question I get all the time is settling a debt, and does it really help your score? So unfortunately, we are in an economy right now where a lot of people are struggling financially. I'm seeing more and more people not being able to keep up with their bills and things going to collections. And you'll hear a lot of mixed information out there, especially on social media, to not pay collection accounts. And if your debt has been sold, that company really, you don't owe them the money and it's against the law for them to collect on you. And so I'm here to kind of dispel some of those myths out there and let you know when you should actually look at settling accounts. So it is true that a paid collection hurts you just as much as an unpaid collection when it comes to the FICO scoring model with mortgages. So people will go, well, why should I even then pay for a collection? Well, in other models that may help you get a credit card, a paid collection no longer counts against your score. So there is that plus. But you also have to be worried with your state statute of limitation. I'm in California, so our statute of limitations is 4 years that a creditor has to seek legal remedies to try to collect on the debt, and that includes filing a lawsuit. So 4 years from the last time you paid. So if anything's less than 4 years old, then you want to be careful, because that creditor can come and sue you, whether or not it's on your credit report. So you may have it removed from your credit report, but that still doesn't absolve you from that debt. If there is a balance there, you actually forever owe it until they write off that debt and issue a 1099-C form. So I highly encourage people, especially if they're higher balances, if it's within the past 4 years or whatever your statute of limitation is for your state, that you may want to consider settling that to prevent any lawsuits against you. I do also recommend always settling utility, phone, or cable bills that are less than 7 years old. These are notorious for moving from collection agency to collection agency. So you may see AT&T come up under ERC collections on your credit report. You don't pay it, it disappears. So you think you no longer owe it. Well, simply all AT&T has done is pulled it back from that collection agency. And next thing you know, you'll get something from ABC collections. And so then it's a brand new collections on your account, and you'll see this happen over and over again. So the last thing you want is a surprise when you go apply for a loan, and then this collection account reappears on to your credit report again. So I definitely suggest trying to resolve any utility, phone, or cable company accounts. And in the credit repair world, we do have a higher success of deletion through our dispute process. So if you are trying to dispute debts on your credit report or working with a credit repair company, it is a lot easier to have accounts removed when the balance is reporting as zero, as opposed to a balance still owing. Charged off credit card. So a charged off credit card is simply a credit card where you've gone over 180 days past due. The creditor writes off the debt in their books as an asset. If they don't issue a 1099-C form, technically you still owe the debt, and they can still report that balance onto your credit report. This can have a very high impact on your score because it is reporting for your payment history, credit utilization, showing that you're maxed out on your card because it's technically a closed card now, but having a balance. And it also can be double reported. So if your account has not been sold and they say assign that debt to a collection agency to collect on their behalf, that collection company can report the debt as well as their original creditor. So it can look like you have two negative accounts on your credit report, and thus double impacting your score. Anytime you can negotiate for a deletion, it's highly recommended. You see this a lot, again, with phone and cable bills, past due rental lease agreements. I see this a lot with debt buyers and third-party agencies that are reporting on a credit report. Most of the time, original creditors do not negotiate for deletion. Usually I only see this if somebody is working with an attorney or there's been some type of credit reporting violation. But if you're working directly with Bank of America, they will not delete. They will just report it as a zero balance, which still can have a positive impact on your score. It's mainly those third parties and debt buyers that are willing to remove once you pay. I always say be careful when going to settle a debt. Deletions cannot be negotiated after it's been paid. You may get tricked into paying things that you don't need to pay, things that are old that are not reporting on your credit report. Or if you get into a payment plan on something where the statute has expired, as soon as you make that first payment, the statute is back into effect, giving them another 4 years or whatever the statute of limitation is in your state for them to sue you. And anytime you do settle a debt, I always recommend making sure you get the offer in writing and have a professional look over it to make sure you are covered once you pay it, that it's not going to come back for the balance owing. If you are ever working with a lender, they will let you know that you cannot have accounts in dispute to have a true and accurate credit score. So in our credit repair world, we do have to put accounts into a dispute status in order to attempt to get them to remove, or I know a lot of people will try to dispute on their own, but then do not know how to remove the disputes at the time that a lender needs to pull their credit. So I'm sharing this screen right here that does have the contact numbers for Experian, Equifax, and TransUnion. Essentially the script that you want to say when you call. And in our experience, these accounts are properly updated and the dispute status is removed within 72 hours, allowing your lender to then pull an accurate credit report with an accurate score. Because when accounts are in dispute, they're actually not factored into your score. So it can give a false sense of a high credit score. And then as soon as you remove those accounts out of dispute, if they are something that's in a negative status, can drive your score back down. So let's get into the biggest credit score mistakes, and then I'm going to go over some top tips to help increase your score in the next 30 days. So here are my 4 biggest credit score mistakes not to make out there. So paying late or a new collection. So as I touched on before, payment history is the #1 predictor or factor in a credit score. It can lower your score by 80 to 100 points with just one 30-day late payment. And sometimes it can be at no fault of your own. You didn't mean to miss it. I see a lot of people not checking their auto pay, maybe setting it up to a fixed amount, and then all of a sudden that fixed amount is not covering the minimum amount due, and you are a couple dollars short and not realizing it because you're seeing that payment come out every month, thinking your credit card bill has been paid, but really you are carrying over a balance month to month because you're not covering that minimum amount due, and it causes you to go late. Other top reasons I'll see are missing annual fees. So maybe it's a credit card you're not using, you're not set up on auto pay, but it is a card that hits you with like a $59 annual fee to just have that card open. You don't realize it goes past due because you miss paying that annual fee, and next thing you know, you have a late and even up to a charged off account on an account that you're not even using. Next is maxing out a credit card. So one maxed out credit card can lower your score by 40 points, and multiple maxed out cards can really affect your score even more. We suggest paying balances to under 10% of the limit. If you are struggling with being able to pay it down, you can also ask for a credit line increase. So the higher your increase is, it can then offset what your utilization is. Just be mindful that if you ask for a credit line increase, you could be hit with a inquiry, but that at the max is 5 points compared to if you can get your utilization down, you can earn a lot more points that offsets that 5-point inquiry hit that you took. An inside tip here is your statement balance is typically the balance that is reported to the credit bureau. So once your statement comes out, that balance is automatically reported. So if you're like the normal consumer, most of us pay our credit cards by the due date. But anytime you paid after the statement balance has already been reported, you're not really getting credit for maybe paying off your bills or paying down your credit cards. So if you're really trying to maximize, your utilization, making sure that it's reported correctly, maybe you're someone that uses your cards every month but pays off the balance, I suggest going in, seeing when your statement balance date is, and paying off the balance or making your payment prior to that date. So then that way the payment is reflected, and then the balance is lower, that gets reported to the credit bureaus. Another big mistake is applying for new credit. So when you're applying for new credit, you're getting hit with the inquiries. Plus, if you have new accounts, your average length that you've had your credit card is going to drop. So anytime you're applying for home loan, we always suggest hold off on applying for any type of new credit. It can just become a big headache and can maybe disqualify you from getting the loan if it drops your score enough. And I touched on this last one, closing old accounts. So FICO looks at your oldest accounts and averages the time that it's been open. So anytime you close an old account, you're losing that amount of time you've had that credit card open for. You want to make sure you're using your accounts every 3 to 6 months so that they are also not closing them for inactivity. Now, 4 steps to increase your credit score up to 50 points in 30 days. And these are all things that you can pretty much do on your own. I might sound like a broken record, but getting your utilization down. So we need to get it down 0 to 10%. FICO does look at individual accounts. So you can start with like your lowest balance account and then work your way up to your highest balance account if funds are limited. We call this the snowball method. So you pay the lowest balance off first and then work your way up. And then that way you're getting credit as you pay each credit card down under that 0 to 10% limit. If you are struggling with having enough good credit on your credit report, maybe you're new to the credit world, a good hack is getting added as an authorized user to a credit card from a family or friend. Basically what happens when they add you onto an authorized user for a specific card, you inherit that credit history onto your credit report. So say you have your mom or dad that add you onto an account that's been open for 20 years, perfect payment history. They keep the utilization under 10%. Not only are you going to get credit for having an account that's been opened over 20 years, you're going to have the utilization may offset your maxed out cards. And it's just giving you more good credit if your credit is not that great. But be mindful that if the card gets put into a negative status, maybe your parents don't pay it on time, maybe they have to max it out. It does hit your score just as it would their score. So if you are an authorized user on something that is a maxed out card or has a bad payment history, it is a good idea to get yourself removed from that account. Also, tip for your parents out there, this is a good method to do with your teens. You can start having a credit history, I believe, at the age of 14. So add your kids on as an authorized user. So that way, by the time they're 18, they already have a credit score, can go out and get a credit card on their own, and you won't have to co-sign for a loan. Next is maybe you need to just open an account. Maybe you don't have a family member or friend that can add you as an authorized user. New to the credit world, opening a secured card, if you don't have any credit cards open, is a good option. That is typically where you have to put money down. That is a security deposit on that credit card. You use it as a normal credit card, pay it off as you would. A lot of secured credit cards after a year will convert it into an unsecured card and give you your money back. It doesn't have to be a huge balance. You can start with something as simple as $250. Another option is opening what's called a credit builder loan. This is good for people that don't have any kind of installment loan like a car or student loan. A lot of credit unions offer this. I do have links for secured cards and a credit builder loan, but a credit builder loan essentially is you are paying into a savings account. The one I have particularly, you only have to pay a minimum of $15 a month, but it reflects onto your credit report like an installment loan. So not only do you have a savings account that you can typically withdraw the funds about a year later, you are also giving yourself a mix of credit onto your credit report, and that can give you a nice little bump in your score. And last but not least, at Blue Water Credit, who I am partnered with, we always do free consultations with our credit advisors. So if you want more personalized advice on what you should do or how you can increase your score, I would love to get you scheduled for a risk-free consultation, and I will have my contact information linked below and on the last slide here. So just to end with, I just wanted to touch on really quick those that are interested in learning more about Blue Water Credit services that we offer. And if we can be of help to you, our four main areas that we can help people in are credit repair, that is disputing derogatory items and attempts to get them removed. Debt negotiations, I handle all those in-house. That is where I'm working with your creditors to work out a settlement to pay less than what you owe and maybe even secure a deletion off your credit report. We also have attorney-backed consumer advocate services who have gotten our clients over $200,000 in compensation for credit reporting violation and phone harassment by collectors. There are laws in place on how a collector, how many times they can call you, what they can say. And if they violate these rules in place, you can be owed a cash compensation. They can potentially have to forgive the debt and remove it from your credit report. And these services cost nothing to our clients. The attorneys bill their fees to the creditors directly. And last but not least is debt management solutions. So those that are dealing with an overwhelming amount of debt, not sure how to pay it off, we have resources for you through credit counseling or a dedicated debt settlement program. So if you are experiencing any of these types of things, we can potentially help you, and we can set you up for a risk-free consultation. I know that there's a lot of places that you can choose out there. There's a lot of gurus out there on TikTok, Instagram, companies. I want to let people know that be aware, 99% of credit repair companies are not legal out there. I'm in California. There's over 42,000 credit repair companies nationally. Only about 63 are legal in California. There are certain state and federal regulations that we must follow. We need to be registered with the Department of Justice. We need to have a surety bond. So I highly suggest before you work with somebody to make sure that they are one of the good guys, because unfortunately there are a lot of people out there that will take your money ask for money up front, which we're not allowed to do, or guarantee certain results. So if you're in California, you can go through the State of California Department of Justice, look on credit service organizations. You can see right here, here's Blue Water Credit. Every state is different as far as the licensing that is required, but I do know that you have to be bonded. There are certain licensing requirements. California has some of the strictest laws in place, and I'm proud to partner with Blue Water Credit. We try to stay on the up and up and make sure that we are compliant in all ways. So I appreciate you guys taking the time to watch this video. I shared a lot of good information. If you have any questions about the information that I shared here, you're welcome to email me, Sarah@bluewatercredit.com, or Sarah@thecreditbosslady.com. If you're interested in getting set up for a risk-free debt or credit consultation, I can help with that. On our website, you can find our 2023 credit ebook. I can give you a link, or you can get our credit builder tools like the credit builder loan or secured cards. If you wanted a copy of this presentation to share with others, feel free to reach out or visit us at bluewatercredit.com. Again, I appreciate you guys. If you like this video, please subscribe, follow, share, and I hope to share more useful tips with you moving forward. Thanks again.